The lithium sector is back, baby. After years of gloom and doom, JP Morgan is calling a massive sector-wide upgrade. And all credit to BEM for this game-changing research report, a piece of work titled Lithium, ESS Demand to Pull the Market into Deficit. For years, we've heard about oversupply, crashing prices, and investor despair. So what changed? Why is lithium suddenly the hottest ticket in the energy transition? Why is one of the biggest banks on Wall Street completely reversing its stance? Stick around, we're diving deep into the data, the stocks, and the electrifying future of the world's most critical battery metal. So what exactly has changed? To get it, you have to picture a split screen. On the left, the lithium market of the last few years. Dim, gray, plagued by a surplus that sent prices into a freefall, a nightmare for investors. On the right, today's reality, an explosion of bright, vibrant color, surging demand, and a complete narrative flip. We're already seeing the results in the real world. Spodumene spot prices, which were languishing, have already jumped from $800 a ton to $950. That's just the start. The real game changer, the secret ingredient that everyone, including JP Morgan, admits they completely underestimated, is the explosive demand from energy storage systems. We're talking about ESS. These aren't the batteries in your phone or your car. Think bigger. Think grid scale. These are massive battery farms, the powerhouses that stabilize our electrical grids, storing energy from solar and wind farms and releasing it when we need it most. They are the critical link that makes renewable energy reliable, and the demand for them is simply staggering. According to JP Morgan's new forecasts, ESS battery shipments are set to rocket up 50% in 2025 and another 43% in 2026. This is on top of the already strong and now upgraded demand from electric vehicles, with those forecasts getting a 3 to 5% boost. This ESS wave is completely reshaping the demand profile for lithium. Just a few years ago, energy storage was a rounding error in the lithium equation. Now, JP Morgan sees ESS eating up 30% of all lithium demand by 2026. And it doesn't stop there. That number skyrockets to 36% by the end of the decade. Let that sink in. More than a third of the world's lithium will be going into grid-scale batteries. The days of surplus are over. They're dead and buried.
We are now officially heading into a market deficit, starting as soon as 2026. The supply side simply cannot keep up with this tidal wave of new demand. Miners who shut down their operations during the downturn need prices to hit between $1,200 and $1,500 a ton just to justify the cost of restarting. This isn't a minor adjustment. This is a total 180-degree reversal from the oversupply narrative that has crushed the sector for years. The game has fundamentally changed. So why is now the time to get back in? Why is lithium suddenly so investable? The answer is simple. The market has flipped from a flood to a famine. We are staring down the barrel of structural deficits, and when demand outstrips supply, there's only one place for prices to go. JP Morgan is now forecasting spodumene prices to surge to $1,100 a ton in 2026, then $1,200 a ton in 2027. They've raised their long-term price forecast to $1,300 a ton. From today's levels, that's a potential surge of 62%. This isn't just a number on a chart. It's the fuel that reignites an entire industry. Higher prices completely juice the economics of mining projects. Suddenly, projects that were unviable become profitable. It incentivizes new supply to come online, and it massively rewards the smart, low-cost producers who are already in the game. After years of pain, after brutal short squeezes and valuations that hit rock bottom, lithium equities are primed for liftoff. You have to understand the significance of this call. JP Morgan was bearish on the sector. They were part of the consensus that saw years of oversupply. Their pivot from that stance to now calling for deficits is a massive signal. It's a green light. This is your window. The energy transition isn't a fuzzy, far-off concept anymore. It's happening right now, and lithium is the irreplaceable backbone of that transition. It's the key ingredient for EVs, for our electronics, and now for the very stability of our future green energy grids. All right, let's get to the main event. Where does JP Morgan say you should put your money? They're not just calling the trend, they're shouting from the rooftops about who they think the winners will be. Let's break down their top picks. Their #1 sector favorite, the undisputed champion of this new lithium bull market,
Pilbara Minerals, ticker PLS on the Australian exchange. They've been upgraded from underweight all the way to overweight, with a new price target of $3.60 Australian.
Why the love for Pilbara? Rock-solid mine plans and massive net present value upside as these higher lithium prices kick in. They are perfectly positioned. Next up, the Chilean powerhouse, SQM. They remained overweight, but their price target has been jacked up to $79 from just $41. That's nearly a double. The bank sees their 2026 EBITDA exploding to $3.3 billion. Now for the upgrade squad. Mineral Resources, ticker MIN in Australia, gets upped up to neutral with a $45 price target. IGO, also in Australia, is lifted to neutral at $5.40. And Liontown Resources, ticker LTR, is upgraded to neutral with a target of $1.10. And don't sleep on the giant, Rio Tinto. RIO-AU stays overweight with a commanding $138 price target. They're a diversified player with a growing lithium footprint. For a more global flavor, JP Morgan is upgrading Lithium Americas, ticker LAC, to neutral. And here's a big one for the Asian markets. Both Tianqi Lithium and Ganfeng Lithium are getting upgraded to neutral, but with their price targets effectively doubled. For Ganfeng, the A-share target is now 65 RMB, and the H-share is 48 Hong Kong dollars. For Tianqi, the A-share moves to 54 RMB, and the H-share to 50 Hong Kong dollars. These are the names. These are JP Morgan's preferred plays, the low-cost leaders, the well-managed operators who are ready to ride this incredible ESS wave to new heights. So there you have it. Thanks to JP Morgan's insightful report, the narrative is crystal clear. The lithium revival is here. It's real, it's powerful, and it's being driven by the undeniable, explosive growth of energy storage demand. We're moving from a market of surplus to a market of deficits, with sky-high potential for prices and for the companies that mine this essential metal. Is it time to upgrade your portfolio? That's a question for you and your financial advisor to answer. But don't let this electrifying opportunity pass you by without a serious look. The world is changing, the grid is transforming, and lithium is at the very heart of it all. Sector upgraded, let's charge ahead. Based on JP Morgan research, generated on Golpo AI. This is for entertainment, not financial advice. Please do your own research before making any investment decisions.